Hey, this is Derek Pilecki. I have a stock pitch for you. I've been buying shares with Genworth Financial. It's a life insurance company. The stock's done nothing for 8 years, but now I think it's poised for some gains. The management team's done a great job of paying down debt, and they've gotten the leverage to where they can start returning cash to shareholders. Genworth trades for about $3.85. I use a sum of the parts analysis. I get about $5.15 as a value. In that valuation, they have a mortgage insurance subsidiary, Enact, that they floated about 19% of the stock last fall. Genworth's 81% ownership is equal to about $5.80 worth of Genworth stock. Genworth's net debt outstanding is about $1.68, so I come up with that nets out to $4.12. But then Genworth's going to get about $1 a share in tax sharing payments over the next couple of years from its subsidiaries, because Genworth has operating losses where they don't have to pay taxes. Subsidiaries just float cash up for their tax liability, and Genworth doesn't have to forward it to the federal government. So I get about $5.12 for Genworth's value. Stock's trading at $3.85. I think the value is going to go up for two reasons. Enact, its mortgage insurance subsidiary, is trading for 90% of tangible book value. I think it should trade for 1.3 times book, so Enact should go from 22 to 32. And then the other source of value is Genworth's announced they're going to buy back shares. And so buying back shares at a discount to intrinsic value accretes value. And so I think that'll be a nice floor under the shares. The other wild card in this stock pitch is I assign zero value to Genworth's life insurance subsidiary, even though there's $11 billion of book value. I do this because it's been involved in long-term care insurance, which has been a tough insurance line. They write insurance policies to 60-year-olds for when they go into a nursing home at 85. So this segment has a long history of poor underwriting, poor pricing. The loss cost inflation has just been out of control. Claims have been much stronger than what were estimated, and it's been hard to get people to stop paying on their policies. Genworth's done a good job of increasing prices and working with regulators to try to get the revenues or the premiums commensurate with what their losses, their claims payments are. There's a possibility that this insurance subsidiary could have some value down the road, but it's so far out for now. I still assign zero value to that subsidiary, but it's just a wild card for the future. So I think Genworth's interesting. I think it's cheap on the sum of the parts. They're buying back shares. I think its main holding is undervalued. And then you have a wild card, a free option on what happens with their life insurance subsidiary.